Two companies. Same revenue. One is a fortress. The other is quietly dying. And you can tell which is which from a single number, in about 10 seconds. Most investors stare at revenue and get fooled. The pros? They skip straight to operating margin. Because that's where the truth lives. Operating margin tells you how much profit a company keeps from its core business, before the accountants and tax collectors get involved. It's the closest thing we have to a lie detector for business quality. Get comfortable with this one number, and you'll start seeing companies the way Buffett does. Here's the problem with revenue. A company can sell $1 billion of stuff, and keep almost none of it. Revenue tells you how busy a business is. Margin tells you how good it is. So what is it, exactly? Operating margin is operating income divided by revenue. You take everything the company sells, subtract the cost of making it, subtract the cost of running the place, salaries, rent, marketing, and what's left is operating profit. Divide that by sales, and you get the percentage the business actually keeps. Why stop there? Why not just use net income? Because net income is messy. It includes interest on debt, one-time tax quirks, and accounting noise that has nothing to do with whether the business itself is any good. Operating margin strips all that away. It answers one clean question: when this company does the thing it exists to do, how much profit falls out? That's why it's the first number I look for. And it sets up the second thing, which is where quality really shows itself. A fat operating margin is rarely an accident. It's usually the fingerprint of pricing power. And pricing power is the fingerprint of a moat. Look at Apple. In its 2023 fiscal year, Apple turned roughly $383 billion of revenue into about $114 billion of operating profit. That's an operating margin near 30%. On hardware, a business that's supposed to be a brutal, commoditized race to the bottom. How? Because people don't buy the cheapest phone. They buy the iPhone. That's pricing power. Apple charges a premium and customers happily pay it, year after year. Now compare that to a company like Microsoft. In its 2024 fiscal year, Microsoft posted an operating margin around 44%. Software has almost no cost to make the next copy, so once the product wins, the profit is enormous. Buffett saw this decades ago with See's candies. He said the magic of a great business is the ability to raise prices without losing customers. See's did it every year. High margins were the proof. And here's the flip side most people miss. But here's what nobody tells you. A single margin number is a snapshot. The trend is the whole movie. Let me show you a company that broke my heart. Intel. For years, Intel was a margin machine operating margins north of 30%, a genuine fortress in semiconductors. Then the trend turned. As competitors caught up and Intel stumbled on manufacturing, its operating margin collapsed from around 30% to near break-even in just a few years. The revenue didn't fall off a cliff. The margin did. And the margin was screaming a warning long before the headlines caught up. This is the lesson. A falling margin, even when sales look fine, means the moat is leaking. Rising costs. Fading pricing power. Tougher competition. The income statement whispers before it shouts. So when you study a company, don't look at 1 year. Line up 5 or 10. Is the margin steady? Climbing? Or quietly eroding? That trend tells you whether the moat is getting wider or draining away. But before you fall in love with high margins, there's a trap you need to see. Now for the twist. If high margins mean quality, then a company with a 3% operating margin must be a bad business. Right? Wrong. Meet Costco. Costco runs an operating margin of only about 3%. Razor thin. On paper, it looks weak next to Apple's 30%. But Costco is one of the greatest businesses in America. Because Costco chose thin margins on purpose. It sells goods at barely above cost, passes the savings to members, and makes its real money on membership fees, with renewal rates around 90%. Low margin is the strategy, not a weakness. This is why context is everything. You never compare a warehouse retailer to a software company. You compare Costco to Walmart, Apple to Samsung, bank to bank. Margins only mean something inside the same industry. The number matters. But the story behind the number matters more. A 3% margin can hide a fortress. And a 30% margin can hide a business about to crumble. Your job is to know the difference. Here's the one idea to carry with you. Revenue shows you how big a company is. Operating margin shows you how good it is, and the trend over time shows you where it's headed. High and rising margins whisper moat. Falling margins whisper trouble. Learn to hear the whisper, and you'll be reading businesses like an owner, not a spectator. Just remember, this is educational content, not financial advice. Always do your own research, and know that past performance never guarantees future results. So here's my question for you: what's one company whose margins you'd trust with your money, and why? Drop it in the comments. And if this changed how you read a business, hit subscribe, because tomorrow we're breaking down the one ratio that tells you if a company can survive a recession.